Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is Zina Spezakis of MA Capital Management. Zina, welcome to the show.
Welcome. Thank you.
Now, tell us a little bit about your approach to the markets. I know it's quantitative, what you do, and it covers the broad spectrum of equities, commodities, etc.
Yeah, so basically we're a systematic shop, which means that a lot of our investing, most of our investing is based on model-driven decisions, and we cover everything from your plain vanilla equity bonds to more alternative assets, including commodities, real estate, and some hedge funds, systematic hedge funds. Yeah.
Now, how has the growth of interest in commodities affected your approach or your portfolios that you manage?
Well, that's an interesting question. It's a good question. The answer is not so simple, right? So commodities, as a lot of asset classes, have gone through some interesting changes in the last few years with the advent of financialization. So a lot of these products have been put into ETFs, where now mom and pop investors have access to them. That's essentially changed the dynamics in the market, and studies have shown that buying commodities through an index, or that sort of financialization of commodities, has changed correlations between commodities and also between commodities and other assets such as equities. So that's something that our models adapt to, because correlations over time obviously change, and so must your portfolio management. But it's something that investors need to be aware of, that some of these correlations have changed and they're increasing.
Now, how have they changed? To me, it seems like it is more of a one-way bet element going on here. I mean, I'll bring up one example, is the involvement of large institutional passive investors, the long-only investors, pension funds, endowments, that now want to hold commodities as an asset class, and they're not really playing both sides of the market. They just want to have some percentage of commodity exposure, and they're basically playing the long side. Isn't that, when you talk about changing your model or adapting it to, this new paradigm, isn't it more of a long-only bet now?
Well, commodities, traditionally have been used by larger institutions, and those have been the players. But what indexation and financialization of them have created is there's many different types of players now. And so commodity, at least the ETF prices, for example, are not necessarily so much a function of supply and demand. They're also starting to be influenced by the sort of relative supply and demand of different assets in the market. The pension plans, sovereign wealth funds, these large investors, global money supply in general has increased. We see a lot of these investors going after chasing yields. They want to make money just like anybody else, and holding it in a savings account, you're losing money if you're, sort of measuring it against inflation. So we believe that because there's all these changes and nobody knows what the next change is going to be, investing needs to actually be adaptive, and you need to be aware of how, not only what asset prices are doing, but how they're acting versus each other.
So it's interesting if you say, like, the commodity markets are sort of becoming divorced from supply and demand fundamentals. I mean, that to me seems like a distortion, a bad distortion. You could actually have, for example, a situation where you have an abundance of something, let's say gasoline or corn, and prices are going up. This makes it obviously negative for consumers. It also makes it negative for hedgers, right? And we've seen examples of this where, a farmer who historically understands hedging and how to apply it, now he's short, his crop, and the prices just keep going up, and then he can't get financing to roll that short over.
Yeah, that's part of the reason regulators have sort of played with the idea of putting constraints on investing.
You think that's good?
I generally don't think constraints are a good thing, and I generally tend to want to believe that the market knows in the long term what it's going to do.
So if we drive, we should just be able to drive as fast as we want to drive. I'll go 100 miles an hour down a school zone. That's good. No regulation.
The corollary to that is that you're not necessarily going to be driving at 100 miles an hour down the school zone, because there's going to be you're going to have a moral sort of obligation to not run over the grandmother crossing the street. So it's, I think regulations need to be smart, and they need to not be, the problem with a lot of regulations, at least in my opinion, has been, there have been one or two steps behind sort of financial innovation, okay? And it's a cycle that keeps repeating itself, and, whether there's going to be an end to that cycle, who knows? But, sort of getting back to investing and sort of your average investor, whether it's a hard asset investor or anybody else, markets are constantly changing. Correlations between assets are constantly changing. And so basing your investment on something that happened in the past that might not longer be applicable, might not be the best way to go. So
how do you, because that's interesting, because in creating your model, you obviously have to have a set of data and make assumptions based on that. Yeah. So you don't use, past performance is not an indication of, is that what you're saying? How do you come about, I'm not asking you to divulge, right, what goes into it, but I mean, and you're saying it may change again. How do you know? What do you look at? What are the signs?
So you don't really know what the future is going to hold, right? So the best thing to do is have really robust risk management measures in place, and whether that is risk management measures that look at short-term trends, or risk management measures in addition to short-term ones that look at longer-term trends. It's the buy and hold sort of model. In the last 10 to 15 years, if you've had nerves of steel, you've probably done okay. If you stayed invested during the dips, you've recovered most of your assets. But what we saw is that a lot of people, if you look at equity mutual fund flows, people sell low and are constantly buying high.
It's the behavior that kills them.
Behavior. So what's that driven by? That's driven by panic and greed, essentially.
And human emotion.
Human emotion. So
you want to take that out.
Yeah. So if you can, the economic models are really based on rational decision making, and that rational decision making isn't necessarily in the market. So so your model or your money manager, whoever's managing your money, you should really understand what kind of risk management measures they have in place. So if they see, factors that may affect bond prices, they should they should make a change in their bond to or from their bond allocation. And so to that detail of investment process. So it's looking less at the individual securities and looking more at asset classes and managing the risks around those asset classes. So.
What would you say to an investor, and we hear this a lot lately, like, you must own gold for the long term. That sort of flies against you just said that buy and hold strategy. It does, over time it doesn't work very well. What would you say to them?
Well, I would say to them, if you can buy and hold and be completely rational, that might not be, whether it's gold or any other asset class, now versus 50 years from now, if asset prices haven't increased, there's something wrong with the planet. But it's that variation that if you can't stand that volatility, buy and hold really needs to be surrounded or enveloped in a robust risk management process. So it really comes down, when investors ask me, should I jump out of the market? Is it getting too risky? Or should I go back in? Or what's happening, Zina? But I tell them, if you can stomach, my first question to them is, can you stomach what happened in 2000, in 2008, 2009? Are you going to be a seller when the market drops? Or are you just going to sit there, or are you going to be more aggressive? So it really comes down to the risk appetite of the individual. There are very few investors I have found, despite what they tell me, that are aggressive risk takers. The vast majority of people will panic, and you see that, and the data proves that out. Because if you look at mutual fund flows, they peak at market tops and into mutual fund flows, and they outflows,
all bail out at the bottom. Everybody should be doing the opposite.
The chart just does not change. If you just look at that, the data is really interesting. Just to look at that,
it is interesting because I've always said, just in terms of behavior, and especially when you look at the United States. We invented discount shopping, right? No other country on earth goes at it with the penchant that we do. I mean, we don't buy anything unless it's on sale, right?
Sure, it's a sport.
Exactly. But yet when it comes to investing, people do the exact opposite. They buy when prices are high and then they sell when prices are low.
Well, I'll tell you something, Mike. It actually is driven almost by the same emotion, right? It's almost if you're going into a Walmart or to a Costco or whatever and you're buying stuff, you're excited about it, right? And so you're plowing more money into it. And, and people would argue that gambling is the same thing, but with investing, you don't want to miss the boat. You don't want to be the last person in your group of friends that isn't in the market. It's interesting. There's always sort of red flags, with bubbles. And during the last bubble, I had a lot of my mom's older sort of retired friends who have never, barely had savings accounts or CDs ask me. They're like, I think I should be buying the market. That right there is a clear sign of emotion. That is not a decision based on any sort of analysis.
Right.
That is not a decision based on even looking at their own circumstances. It is simply it's a greed response.
Right.
And the same thing on the downside.
Right. Like the magazine cover indicator.
Yeah, exactly.
Zina Spezakis, thank you very much. Fascinating. Very interesting.
It was a pleasure, Mike.
MA Capital. That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.